The US stock market is unstoppable. The US economy has just gone through the worst inflation in 40 years, the highest interest rates in 2 decades, and tariffs at levels not seen in half a century. Growth is slowing, recession risk remains, and yet the market keeps going up. From 2019 through 2024, the S&P 500 grew at an average pace of nearly 20% a year, almost double its historical norm. Even in 2025, the index is already up another 10%, setting fresh all-time highs one after the other. If not for the Liberation Day crash in April, the rally would be even stronger. By traditional logic, this makes no sense. If stocks are supposed to reflect the health of the economy, then the higher borrowing costs, weaker consumer demand, and slower growth should be dragging valuations down. And yet, the opposite is happening. So, is the market acting irrationally? Or are there some hidden reasons that are driving it higher? I came across a fascinating article titled, "Does the stock market know something we don't?" that dives into this very issue, which I'll leave the link down below. So, let's jump right in. According to the article, the first and probably most straightforward explanation for the stock market going up is the fundamentals theory. In Investing 101, stock prices reflect the earnings potential of individual companies. If a business consistently grows its earnings, improves efficiency, and generates stronger cash flows, then its stock price should rise in line with that performance. The fundamentals theory also explains why bubbles form from time to time. When investor expectations run too high, stock prices often rise much faster than the earnings that support them. As valuations become stretched, the gap between price and reality widens until it becomes unsustainable. Eventually, the bubble bursts, and markets fall back to reflect companies' true worth. Hence the term market correction. For a long time, this framework worked really well. Take the 2008 financial crisis for example. Within 6 months of the US banking system's collapse, the markets plunged almost 46%, almost perfectly in line with the collapse in corporate earnings and balance sheets. In response, the Federal Reserve slashed interest rates to near zero and unleashed unprecedented liquidity programs. This sparked a dramatic recovery in stocks, and yet, throughout much of the 2010s, the underlying fundamentals remained weak. For example, while nominal corporate profits more than doubled between 2010 and 2024, the profit share of the national income averaged just 13.9% during 2010 to 2019, showing that companies weren't actually earning substantially more relative to the overall market. Labor productivity rose only 0.8% annually between 2010 and 2018. Far below the long-term average of 2.1%, and between 2010 and 2023, total corporate revenue increased just 83%. Despite this sluggish backdrop, the S&P 500 surged by 225%. In fact, you can see that after 2008, the S&P 500 turned parabolic during the QE years. That gave rise to the liquidity theory. The idea was that central banks, particularly the Federal Reserve, have become the principal drivers of the stock market. Quick pause, with USmart, you will enjoy one of the lowest trading fees in Singapore. For US stocks and ETFs, it is a simple flat fee per trade. For the Singapore market, you will only pay commission plus a 0.03% platform fee. And best of all, no minimum charges. On top of that, you can start a regular savings plan to invest in more than 10,000 Singapore and US stocks and ETFs with absolutely zero fees. And if you are new to USmart, you can sign up today to receive up to $200 worth of welcome gifts, including cash vouchers, Tesla share vouchers, and free live market pricing for both US and Singapore markets. So sign up for USmart SG using my link down below to enjoy this exclusive offer. Now, let's get back to the video. By flooding the financial system with cash, they effectively keep pushing asset prices higher. If you plot the growth of the M2 money supply against the US stock market, you will see that the two move closely in tandem, both rising steadily over time. In fact, one study found that the cumulative growth of the Fed's balance sheet showed nearly an 87% correlation with the S&P 500. The only divergence came near the peaks, when the Fed expanded money supply so rapidly that stock prices couldn't keep up. This isn't surprising when you consider that stocks and real estate represent the largest components of the US household wealth. Together, they make up more than half of the household assets, with equities alone valued at around $56 trillion and housing close to $48 trillion in 2024. When stock prices rise, so does household wealth, lifting consumer confidence and encouraging more spending. But when markets fall, the reverse occurs, triggering a negative wealth effect where falling asset values weigh on consumption and can drag down the broader economy. This is also why some argue that the government simply cannot afford to let the stock market crash. a severe downturn wouldn't just hurt investors, it will also erode household wealth/tax revenues, which heavily rely on capital gains and risk tipping the economy back into recession. For years, this explanation held up, but in 2022, the picture changed. Inflation surged to multi-decade highs, forcing the Fed to aggressively raise interest rates and embark on quantitative tightening. Over the following 2 years, the Fed's balance sheet shrank by about $2 trillion. Conventional wisdom suggested that draining liquidity on this scale would trigger a deep correction. Yet, against all expectations, the stock market did not fall sharply. Instead, it surged. In both 2023 and 2024, the S&P 500 climbed nearly 25% each year, making it the market's best 2-year run of the 21st century. During that period, another narrative started to dominate. The growth of the S&P 500 was being driven almost entirely by 7 mega-tech companies: Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia, popularly known as the Magnificent Seven. At one point, these 7 companies accounted for nearly 2/3 of the index's total returns, despite making up less than 30% of its market capitalization. While the largest holdings in the US markets have always played an outsized role, this degree of concentration is historically rare, surpassing even the dot-com bubble. This gave rise to another new theory, that the AI revolution was supercharging the stock market. The idea was that artificial intelligence could transform entire industries and drive productivity on a scale not seen since the internet boom. Nvidia in particular became the face of this rally. Its stock soared more than 1,400% since late 2022, fueled by expectations of huge demand for its AI chips, and it became the first company in history to hit a $4 trillion market capitalization. But now, cracks in this narrative are starting to show. A recent MIT study revealed that 95% of enterprise generative AI projects failed to deliver measurable business results, suggesting that corporate adoption has been far less impactful than investors assume. Even OpenAI's CEO, Sam Altman, has warned of irrational exuberance, saying that while AI holds enormous potential, some investors are going to lose phenomenal amounts of wealth when the hype inevitably collides with reality. For a brief moment, it seemed that the day had finally arrived on April 2, when Trump unveiled his sweeping Liberation Day tariffs. Within days, the S&P 500 plunged more than 10%, wiping out trillions in market value. But just a week later, on April 9, Trump unexpectedly retreated from his most aggressive proposals. Markets soared back, staging one of the strongest rebounds in recent memory. Traders quickly dubbed it the taco trade, short for Trump always chickens out. The idea was simple. Every time Trump threatened the market with tariffs, he would eventually retreat, sparking yet another relief rally. But yet, this explanation doesn't really hold, because Trump hasn't truly chickened out. Tariff rates are now at the highest levels in decades, and the president continues to announce new duties one after the other. Meanwhile, consumer sentiment has sunk near to historical lows, and the broader economy is starting to show cracks. Despite all that, the stock economy has defied all expectations and continued climbing even higher. If the tariff shocks, the AI boom, and even the Federal Reserve's policies can't fully explain why the stock market keeps rising, then perhaps the answer lies elsewhere. This brings us to one last theory, the rise of passive investing. So back in the early 1990s, the investment landscape was very different. Actively managed funds dominated, while strategies such as index funds only had a minor presence in the market. Today, however, almost half of all fund assets are in passive vehicles. A major reason for this is the growth of retirement accounts, such as 401ks and Roth IRAs. With over $6 trillion in assets, 401k plans often default participants into index or target date funds, ensuring steady inflows into passive investments regardless of market conditions. At the same time, Roth IRAs have surged in popularity, especially among younger investors, and the most common holdings are index funds and ETFs as well. Another factor is cost. The average US equity mutual fund fee has fallen dramatically, from around 1% in the 1990s to as little as 0.03% for index funds today, saving investors billions of dollars each year. Meanwhile, decades of evidence show that the most active managers fail to beat their benchmarks. Roughly 90% underperform over a 15-year horizon, making the case for higher fee active funds even weaker. Endorsements from respected voices have also helped. Warren Buffett famously won a $1 million bet that a simple S&P 500 index fund would outperform hedge funds over a decade, cementing passive investing as the default choice for long-term wealth building. Finally, retail investors are taught that time in the market beats time in the market, and to embrace dollar cost averaging under the belief that markets trend higher over time. This creates a self-fulfilling cycle. As passive funds push prices higher, investors become more convinced that markets always recover, which encourages even more inflows. Over time, this has made stock markets more resilient to shocks, with drawdowns less severe and V-shaped recoveries like those in March 2020, December 2018, and April 2025 becoming more common. But then, those studies show that passive investing doesn't actually inflate stock prices. For instance, data from the CFA Institute notes that ETFs account for only about 5% of US stock market trading activity, and even in cases of heavy ETF ownership, the impact can seem small. Apple, for instance, is held by over 330 ETFs globally, yet 95% of its daily trading volume is unrelated to ETF flows, suggesting that active investors remain the main price sectors. Yes, ETFs may only be a minority of daily trading, but when you have such large and persistent inflows from passive investing, these flows inevitably reshape ownership and capital allocation over time. That's why drawdowns have become shallower, recoveries sharper, and perhaps more importantly, why indexes have become far more concentrated. Unlike active investors who may avoid mega cap stocks that view as overvalued, passive funds don't make such judgments. Because most index funds are market cap weighted, whenever a company's value rises, passive funds are forced to buy even more of it. This creates a powerful feedback loop, where the largest companies such as Apple, Microsoft, and Nvidia attract ever larger inflows, concentrating overall market performance into just a handful of names. In short, passive investing has clearly become a powerful structural force in today's markets. The steady inflows from retirement accounts, the appeal of low fees, and the discipline of dollar cost averaging have made the markets more resilient and more concentrated than ever before. Still, it may not be the full story. Passive investing could continue to explain this rally, or it might eventually be disproved, just like so many market theories before it. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.